Alright, so today we're going to answer this question in financial reporting. This is a past paper from Cavendish. So I'm answering question number 2, part A, which has got a question from IAS16 property plant equipment. So the question reads, Mukaka purchased an equipment on 1 January 2021, and the cost of the cost schedule below has been given to you for your review. All costs were paid on 1 January 2021. So we have the cost of equipment, which is the purchase price 95, trade discount of 15, other relevant cost of 10,000, and then we have training cost 2021 of 40,000, and the compulsory dismantling cost at the end of 10 years of assets life is 8,000. We are also told that the equipment is depreciated on straight line basis over 10 years. And the dismantling cost is to be discounted at a discounting factor of 0.5, and the applicable cost of capital is 6% per annum. So one thing, if you are dealing with financial reporting, one thing you need to understand is the rule. Every question, for as long as it's not a general knowledge question or a question from matters affecting modern accountants, it's a question that is from a standard. Make sure you apply the rules based on that standard. So the first thing in financial reporting is to know, where is this question coming from, on what topic? So here we have established that this comes from IAS16 property plant equipment. What does IAS16 say about the cost of an equipment, of a property, okay, of a plant? In this case of equipment, what does IAS16 guides? So IAS16 guides that to establish the cost of in this case this equipment, we need to get the purchase price. Okay, that's how the standard guides. We just follow the standard. So you get the purchase price, you less any trade discount. Okay, once you less that, you need to add any cost that contribute to bringing that asset into working condition. So that will mean delivery cost, transportation, testing, technical cost, those things. If you labor, if there was labor that was being paid for in bringing that asset into working condition, should be added to the cost. So any direct related costs will be added to the cost, to the purchase price. Okay, but also taxes and import and duties, customs duty, they will be added as well. Okay, non-avoidable costs should be added. All right, termination costs should be added. The dismantling cost here, like for example, we have also installation cost should be added to the cost. All right, and then make sure to understand rules that apply to those costs that we don't add it to the purchase price, like training cost. Training cost is not added to the purchase price. Why? Because the entity is guided by IAS16. An entity won't benefit, or the entity does not have a control over the employee's future actions. And as such, this one will be treated as an expense in the income statement, as guided by IAS16 property plant equipment. Okay, also if you are going to find something like cash discount, it will be an expense in the income statement. Okay, it does not, we don't add it to the purchase cost. Alright, also, having established that, we need to then now, how then do we come up with the costs? How then do we come up with the costs? We need to do those calculations as guided by the rules. Okay, so this amount, dismantling cost, is the future costs. Okay, so we need to discount it to a present value of this amount. That's why we have a discount factor 0.5. This 10 years will be used when we're calculating depreciation. This 6% will be used when we're calculating the interest, okay, or the finance cost. Okay, so now let's read the question. Having understood everything on this question, let's read the required. Required. Show the appropriate accounting entries in the income statement and the financial statement for the year ended 31st December 2021 12 marks. So this is the 3-mark question. Once you find this question in the exam, get it, write it, get it right. So let's guide each other on how to do the computation. So we're going to do the computation of search. So this is what we do. So you write cost charge, and then you underline, and there's a purchase price. The purchase price we are told is 95,000. We said we less trade discount, which is trade discount, which is 15,000. So when say 95 minus 15,000, we get 80,000. So we have 15,000. Okay, we get 80,000. So now we add any other relevant costs. So we are told that 10,000 were other relevant costs. So we add. That's why we have this one here, 10,000. So when we add that, we'll get. We need also to add a dismantling cost, because this is a dismantling cost, and dismantling cost we have been told that it is 8,000, but we discount it at 0.5. So let's do that. We discount that at 0.5, 8,000 at 0.5, so we get a 4,000. So then we add 80 plus 10 plus 4 is 94,000. This will be our new cost. So once we have the cost now, we can go ahead and do what? And answer the question. So now we have the income statement. Let's do this income statement. So income statement. Okay. So the income statement, I need to adjust here. The income statement. What goes into the income statement? So the first thing that goes into income statement is depreciation, and I'm going to put here balance sheet or statement of financial position. Balance sheet. Okay. So we have the balance sheet. Alright, then we have the income statement. So what goes into the income statement is number one, depreciation. So depreciation will go in the income statement. We have depreciation going into income statement. How do we calculate depreciation? It will be the cost less residual value. Okay, then we divide that by useful life. Divide by useful life. So let's do that. So now our cost, we've just found the cost to be 94,000. We divide by useful life, which is 10. We'll get a depreciation of. We get the value for depreciation to be 9,400. It is already in the income statement. Again, what else goes into the income statement is the finance cost. financing cost. So the finance cost is 0.06 multiplied by 8,000. Okay, because we were told that the cost of capital is 6%. Okay, so now we will have to discount that. We'll have to multiply that by the 8,000 that we have been given in the question. So we get 4. Oh, we will multiply that by, now this 4,000, this 8,000 is the future value. So this 6% will be multiplied by 4,000, the present value we just calculated after discounting. So here we will multiply it by a 4,000, the present value. We don't multiply by the future value. So it will be 0.06 multiplied by the 4,000. We'll get 240. So we'll put here 240. So that is what we have in the income statement of the depreciation and the finance cost. What else comes into the income statement? Training costs. We said training costs go into the income statement as the expenses because they do not form part of the cost of an asset here as guided by IAS16 property, plant, equipment, and it is actually 40,000. Okay, what goes into the balance sheet? So for balance sheet, the first thing that goes there is the cost. You know, in balance sheet our aim is to we have the cost. How much is our cost? Our cost is simply 94. The one we calculated, 94,000. How much is depreciation? Depreciation also goes there. I'll just say depreciation of 9,400. When we subtract that, what do we get? When we say 94,000 minus 9,400, what do we get? We are getting 84,600. What is this? This is our NBV. This is our net book value. Now that we have this one, there's one component again that will have to go on in the balance sheet, which is a non-current liability. Non-current liability. So non-current liability, I'll need to do the calculations here because we have two things. This 4,000, it was discounted. We discounted the 8,000. So the dismantling cost becomes a liability. It's a non-current liability because so we're going to add that plus the finance cost as well, 240, will be part of a non-current liability. So in the end, we will have 4,240 as our non-current liability. So this is the answer to our question here. So for you to get your 12 bucks. So that's the answer to this question. So register with us for extra lessons. We do more of this, guide you, give you materials, guidance, and teach you on how to easily handle these courses. So until then, it is bye for now.